Welcome to the Registered Investment Advisor Podcast, where financial services marketing expert Seth Green interviews experts, executives, and top producers to share can't-miss tips on how they successfully manage their financial service firms, grow their businesses, create great relationships, and influence the industry. And now, here's your host, Seth Green.
Welcome to the podcast. This is your host, Seth Green. Today, I've got the good fortune to be interviewing Bernard and Larry from Measured Risk Portfolios, who have a really interesting strategy to both measure, manage, and define, and of course, reduce risk without trading away returns. Bernard, Larry, thanks so much for joining us.
Thank you very much, Seth.
Pleasure.
So we'll get into the strategy in just a minute, but I want to back up just a second because you've had an interesting history in the business before Measured Risk. So can you talk a little bit about how you got started in the financial services and money management business in the first place?
So I started out in the financial services industry back in the 1900s still, and late 1900s. I'm pleased to admit to. And I started out with an insurance company, and very quickly it got taken over by another insurance company, and that was kind of where I ended up meeting Larry. And the experience we had during the 2000 through 2002, 2003 time period was one of learning that just because something has happened in the past doesn't mean that the same set of facts will happen again in the future. And I met up with Larry, I think it was 2006, 2007, Larry. When did we meet? About then, right?
A little earlier, late 2005.
Late 2005. And it was kind of a funny meeting because it was at a company-sponsored event, and we were at the dessert thing, and Larry made a comment to me about how, some nefarious comment he made, and I was like, yeah, I need to move offices, and we decided to do an office share arrangement, and we became partners. And sometime thereafter, we actually formalized the thing and became partners. But in terms of the experiences we both had during the 2000, 2001, 2002 time period, we had a real kind of meeting of the minds on that, of that the old way of doing things just simply doesn't work in a crisis, and didn't resonate to people that there might be another way of doing things. And it got Larry and I kind of on this whole road to exploring other alternatives to just the traditional way of investing money. And it led us to build our portfolio, which we'll discuss in a little while here. But
and I think the major key that's missing is that the 2000, 2003, that tech bubble bursting, spawned a number of interesting products, because part of what we're trying to get our arms around is that backward-looking data, the non-correlated assets, they move up and down independently of each other, which is what you want for something to be able to sell from when it's high and buy low from other constituents in your portfolio asset allocation model. And that does tend to work in normalized markets. There are things that are moving independently of each other. But when a crisis develops, we've observed that all those non-correlated assets become correlated and all start to go down at the same time. And that kind of blows the whole opportunity to rebalance or to take advantage of maybe some dampened volatility. So what ended up happening is then we end up with the manufacture of managed futures and commodity indexes and inverse products that can go up when the market's going down, and then levered inverse products. These are all attempts to try and find something that you can add into the asset allocation model to solve this problem and to make it mechanical. That was the quest. And we unfortunately tried a few of those. And so through hard, painful experience, we've learned that products that have historical track records that have performed a certain way in a certain set of circumstances can suddenly turn around and change their stripes and behave differently in the next crisis. And so we really got to a point where we have to do something really different in order to expect a different outcome. Otherwise, we're just going to be stuck having a similar disappointing outcome eventually. It seemed like it was inevitable. So that was the genesis of our looking for something else.
So there are obviously a number of RIAs, thousands, nationwide, who went through the similar experience in terms of the frustration with whether it was a tech bubble bursting or the subprime bubble bursting in 07 or 08, or what happened with COVID. And I'd say 99% of us probably said, oh, I wish there were a better way. And it ends there. But you actually said, let's actually figure out the better way, design something and implement it to achieve what would be a better way. So talk about that transition from, darn, this is frustrating, to we can actually engineer a process that delivers a better outcome.
Yeah, so that's a great question, Seth. For me, and I don't know if Larry there's a product in the insurance company, in the insurance industry called the equity indexed annuity. And we just love the story. I mean, the story that it says is, get S&P like returns on the upside and don't get any downside. And, Larry and I would look at that comment and marvel at that and go, well, how do they do that? It's like, how do you capture upside and not participate in the downside? Sounds incredible. And needless to say, there were, good amounts of money flowing in that direction, but it wouldn't necessarily work on the upside as well as you might expect, because they all had caps on them. And, if we're going to be equity investors, we want to try to get more, obviously on the upside. And so Larry and I don't remember exactly how Larry did this, but he got us invited to a conference in London about, in the insurance industry, like guts, for lack of a better term. And we went to meet the guys who actually built the equity indexed product. And they gave us the recipe, which is not very complicated. It was appallingly simple. When we saw it, it was like that eureka moment. Of course, duh,
Yeah, so I mean, for those of you, I think RIAs are listening, they'll have some appreciation for what an indexed annuity is and also what it isn't. I think a lot of the retail advertisements lead you to believe it's an equity-based kind of return because you're getting your interest credits from the movement of some market. It used to be just the S&P 500, but now you can tie it to almost anything in these products. But the reality is that they do have to deliver on this guarantee of typically no losses, no downside. And so the first trick for us was how you do that. And it was such a simple recipe, as Bernard alluded to. They use basically zero coupon bonds or an equivalent where you maybe invest $95,000 out of 100. And within a year or so, that $95,000 will grow and mature back to $100,000. And that leaves you free to take a really big swing with the $5,000. So that $5,000 is used to buy options or some derivative on whatever the index is that you're trying to benchmark your performance to. And that way, if the index is negative or goes down, you'd lose your $5,000 option allocation, but you get back your principal with the $100,000 maturing bond. And so all we did is take that very, very basic idea, and we said, listen, we're not looking for no downside. We're prepared to invest in the S&P 500. We're willing to take some risk. And so we just want to know what that risk is before we take it. And instead of having a mix of investments now that has a historical performance of maybe going down XYZ%, we can now say, well, let's just take a 5% risk or a 10% risk. And all we do then to achieve that is just invest more than what we're going to earn on the interest. So instead of investing $95,000 in a 5% world, having it grow back to $100,000, maybe we agree to invest only $90,000, which will only grow back to $95,000. And that way we're going to have $10,000 to invest in options, which is twice what the insurance company can. Or we want to say we have a 15% downside risk tolerance, and we can then put only $80,000 into the, or 81,000 or some such number into the bonds, grows back to 85,000, and that gets much more buying power into the options. That was the difference. That was the difference. And it's, to my knowledge, not being done by any other firm out there. We're the only ones who offer it.
Which kind of boggles my mind, because when you think about it, as Bernard alluded to, how an equity indexed annuity, like the math behind how it works and the investments you need to pull it off it's a relatively simple recipe. Theoretically, anybody could do something like that, but you're the only ones also, to my knowledge, in our research in the industry, who have engineered a way to pull that off and customize it for every single client based on how much risk they're willing to take. Why do you think no one else did it?
I'll take that one. I think it's actually distribution. And this is kind of not the greatest response for our industry, but if we can't get the product into the most clients' accounts as we can, then the industry is not interested in it. So we have been unable to get on a platform like any of the third-party asset managers of any merit. We can't really design the structure. At least we haven't been able to find someone to help us design the structure to be in a 40 Act mutual fund or in an ETF model. And as a result, the separately managed account is the only way to get this into the client's allocation. And that just means that it's much more difficult. The client has to open up an account, and the account has to be funded, and then the account has to be papered. It has to be papered for options and margin. These are all much more complicated structures than it is just to simply right-click a drop-down box and allocate 15% to another portfolio manager's model.
Absolutely. And you've been doing this now for quite some time. How has it performed the way mathematically you expected it to?
Yeah, it's one of the beauties of this structure is that when you have let's say a 90% allocation to treasuries, short duration treasuries, by the way, so we're not going out 5 or 10 or 15 years and subject to interest rate risk, but short duration, typically 18 months or shorter. And then you pair that up with an option. When things go well, that option can just explode in value. It's very similar to like a home. And if you have $1 million home that you purchased and you put $100,000 down and finance the 900,000, and then that home over the course of a year goes up by 10%. So your home is now worth 1.1 million. Well, your equity, the 100,000, went up 100%, right? So that's that inherent leverage in that down payment kind of example. And that's exactly what we're doing here. We're just doing it with derivatives or options on the S&P 500. We're taking a small allocation that can control a large amount of capital. And we're using that to basically get our return. If the markets decline, 100% of that option value is at risk. And we have and did just in 2022 lose 100% of that option allocation for all of 2022. But in the prior years, performance, by the way, is available on our website, measuredriskportfolios.com, and that's under the strategy section. But the performance in 21 and 20, we actually outperformed the indexes that were benchmarked to. So we're able to provide net higher investment than we were in the S&P 500. So. And that's back when there was no yield on the bonds. And there was essentially something less than 1% available in fixed income. And so we're looking forward to this environment where we actually can get yield on bonds. In theory, leads to the potential for a higher potential return. Now, again, markets have to cooperate. If they don't go up, we don't make money. And in fact, this strategy can be less favorable in a small decline, or even in a small positive year. So a 1 or 2% year can actually deliver negative results in our strategy. A 2 or 3% decline could be a 5 or 6% decline in our strategy. So we're looking for market movement that's positive in some meaningful way in order to overcome the expense of owning an option, because they don't come for free.
I mean, just on that point, Stephan, oftentimes the market, even though you end up with an average of 10, you very seldom get 10% on the S&P. More often than not, you're getting returns that are well in excess of 10s or well below 10. So it's very seldom that you're at that 10. And in fact, when we look back at some of the data sets, it's really quite revealing how often the market goes up more than 15, 20%. It's not an uncommon event. It's those big numbers, the 50s and 60s. Now those are very, very uncommon. And on the downside, however, it's turning out to be more common for it to drop 20+% in a relatively short time period. We had the 2008 crisis, we had COVID, now we're having this banking thing. I mean, this year hasn't been the last year hasn't been the brightest year on the market, but so those big down years do materialize. And then when you start to look at the math of all of it, then you really start to appreciate exactly what we do. Because if your portfolio is down 10%, you need to go up 11. Well, again, you look at the S&P distribution of returns, pretty high probability. Well, the problem is the market drops, 25%, or your account drops 25. Well, now you need a 33% return. Or the market drops 50. Well, now you need a 100% return. Now, these are big numbers. And when you start to look at the frequency of those numbers, it just becomes very infrequent. And so what we're able to do by protecting the downside, we're buying back time. So time for that portfolio to recover instead of needing 3 or 4 years. For example, in 2008, we had a recovery within months of the market being down a lot because we were able to limit that drawdown. So time is what you're buying, and it's the one thing that you really can't buy, generally speaking. That time for it to recover, we're shortening that up to a very, very narrow time frame because we limit our drawdown to a manageable number, be it 10% at the client's behest or whatever the number is, but smaller numbers which are much more easy to recover from.
It makes a lot of sense. And the genesis of the idea coming from, an equity indexed annuity. Now, equity indexed annuities typically get some flack in our industry for either the fees that you're paying, or if you're in one of them that isn't that structured, the fee comes out of the participation rate of, hey, I'm giving up X% on the upside in exchange for the percentage of the downside. Yours works better than that and doesn't require any cap. Talk a little bit about that.
Yeah, that's a great observation. So when you look at the way that the equity index product is constructed, they use a thing called a spread. So, they'll buy an S&P price point here, but they'll sell it over there. So all you're going to get is this portion of the movement. We've said, no, we don't like the idea of capping the upside. When the market runs, you really want to get that upside. So we don't do a spread. We buy a long call, and we do it generally with a 1-year expiration at inception, and we let it run and we see what happens. And if things go well and the market is running up, we will then, depending again on the market and what's happening, we will sell that call and possibly move up its price to take some of the money off the table and add it to the safe money, or we'll roll it further out, meaning giving us more time for that option to, for the market to get to that price point. But we are always actively managing the options exposure and to be able to harvest the gains.
That really is a critical component, because unlike a structured note, which is available outside of an equity index annuity or the index products themselves, they typically will have either a point-to-point or potentially a multi-point, a 3-year deal with some points along the way. But with measured risk, we're actually monitoring that on a daily basis, and we're paying attention to what the movement of the options are relative to the movement of the underlying index, and we adjust along the way on the fly. So if there is, as Bernard is saying, potential gain growing, we don't want to be in a situation where we watch the S&P go from, say, 4,000 to 4,800 and then back down to 4,100, leaving just a very small gain on the table, when we could have been locking in those gains along the way by selling the profitable options and repositioning them. So that's what we're doing as well. One other quick comment, though. I mean, the traditional portfolio construction, whether it's 70-30 or 60-40, is generally 60-70% equities, and the S&P 500 is kind of that large 800-pound gorilla that everyone's trying to benchmark to. But still, think about this. If you have 60% of your portfolio in, say, the S&P 500, which can go down 50%, let's say in 12 months or very close to 12 months, you're still taking a 30% drawdown risk, a 30% decline risk in your softened portfolio. In your 60-40 portfolio still has tremendous downside potential, well in excess of what most clients are prepared to take. And that's what we wanted to try and solve, because even when you have a 60-40 portfolio that is in theory buffered, when the markets are really tanking, and that's when bad decisions start to get made, and by that I mean selling out of those equities typically near a low, when that 60-40 portfolio is down 22% or 24%, and the client's on the phone with the advisor asking, well, geez, Tom, how much more do you think we can go down? And the advisor we didn't have an answer back then. And so that's what we were trying to solve, is how are we going to get ourselves out of the situation where we can't give our clients the confidence that we want to give them and being able to stay invested.
That segues perfectly into my next question, which was, how has this been received by the end user retail client? How have they understood it when you explained it to them? And then what kind of, you're getting a lot of different feedback than normal advisors are used to getting because of the different way to manage the risk. Talk a little bit about the feedback from the clients.
Well, let me take one of those. I always think back to the story that happened, I think it was October of 2011, and Larry's heard this 100 times, but one was okay. So as I recall, we had a fiscal cliff, a debt ceiling, sound familiar? History has a way of repeating. So, and we had an election coming up, and I got a call from this client, and they had, something, just shy of $1 million with us at the time. And interestingly, the wife called, which was not common. I didn't generally get to have a call from her. But she called and she goes, my husband and I, we're very nervous. The markets are doing this. There's a fiscal cliff, a debt ceiling. I mean, these terms are just like, wow, fiscal cliff, debt ceiling. It's like, oh my gosh, it's enough. Alone is enough to, conjure up horrible images. And she says, we're thinking we want to take all of our money out, and we're very nervous. We can't sleep. So I said, well, okay, are you in front of a computer? And she goes, yeah. And so, by the way, another benefit of a separately managed account is what I'm about to describe. So I had to log onto the computer, and we could see her positions, or not her, but their positions. And I went through them individually with each position. And at that point, the options had whittled down to being worth about, 2% of the account, so not very much. And I said, well, those options, if things go poorly, those options will go to zero. Then when I went to the fixed income positions, and I said, look, even if I take off 2% from the fixed income positions, which I thought was an unreasonably harsh penalty under the circumstance of, it was mostly treasuries. And let's assume that happens, then your account at most could lose another, and I gave her a definitive number. I was actually able to say it's going to lose this much more money. So, and again, she looks at the positions, and what I'm getting back is silence. And I'm like, I wonder what's going on, because I don't, like, I've said everything I can say. I don't know what more to say other than, are you still there? And to which the reply comes, oh my gosh, I can't believe what good care you're taking of us. I'm so sorry for bothering you. I'll never bother you again. And it occurred to me that in her mind, the whole account was at risk of imploding, because when somebody's invested in the market, they don't look at the component pieces. They look at the portfolio. The portfolio's lost money, because again, the way our portfolio is designed, if the market's down 10, we're going to feel that 10. But then we flatline. And the interesting part of that story was the part two, as we all remember, that the fiscal cliff got taken care of, the debt ceiling got taken care of, the election got taken, was resolved, and the markets rallied back pretty hard. And she actually ended, I believe we ended up for that year. So those options that had de minimis value in the account on the day that she and I looked at it exploded in value once the market started rallying again. So it wasn't that Larry and I had to then add more risk at that point in time. The risk was already allocated. Now we just don't let the market do its thing. And so I like to use an analogy. We kind of like pilots flying, with complete turbulence, all right, steady. But we're not going to get as much of the turbulence as somebody who's doesn't have the
other thing that happens, Seth, is that now we've been doing this now for, as you say, many years, and we have realized that we're down to there aren't any phone calls during a financial crisis. So when there's markets selling off because of COVID, or if markets are selling off because of the banking crisis, or if markets are selling off for fill in the next crisis, we don't have concerned clients, because we have disappointed clients, and the advisors that go with them. They're disappointed because the markets are going down and they're going to be hitting some of those stop losses that we've got in the portfolios, but they're not anxious. It's a whole different position to be in. And on top of that, as we've gotten better at coaching our advisors, the opportunity now arises that if the market is declining or it's in free fall and it's going through one of its worst phases, you find yourself sitting on a pile of treasuries, looking out at a sea of investments that are on sale. And it's the perfect place to be in if you have the courage to do the investments. And our firm won't do it for you, because our mantra is to limit those losses. But if you come knocking on the door and say, hey, I want to peel off another 5%, allocate it to some more options, we will cheer your name in the hallways, because I don't know about the timing. I can't be assured that the timing is right, but I do know that we've positioned you in a way that you can actually potentially take advantage of a declining market instead of just being a participant in it.
And that's a beautiful thing. And you mentioned your advisors. Talk a little bit before we wrap up about how you are now helping other RIAs and advisors add this to their toolbox and help their clients.
Right. Well, I would say our ideal relationship partner is a mid-sized to large-size RIA that can take a look at our performance and our structure. We do adhere to GIPS, so we're GIPS certified back to 2016, and we're able to show and demonstrate that we have, now we've had up performance, down performance, and there's plenty to look at there. We're looking for firms that are understanding that they can't get this type of performance structure in any other way than an SMA, and that they'd be willing to look at doing business through an SMA relationship. And we can operate as a sub-advisor, we can operate as a solicitor for where we're the primary and we take solicitor relationships. But we're actively looking for partnerships to be able to get this strategy out into the right hands. And one of the key areas, if you're a younger person with 40 years to go before you retire, you can probably handle the ups and downs. But with what we find is that the pre-retirees who've maybe gotten to be 55 or 57, who could still use that equity potential return, but are concerned about the risk they face if they try, we're a really good solution for that, because you can actually position the portfolio to be pretty aggressively structured from a potential rate of return, but still limit the amount of drawdown to that defined amount that you're agreeing to bite off.
And that's a beautiful thing. Well, we know your time is incredibly valuable. We greatly appreciate you spending some of it with us. For our folks watching and listening, whether they are an end user retail investor or an advisor, registered investment advisory firm, make sure to check out measuredriskportfolios.com. This has been Seth Green with Larry and Bernard from Measured Risk. Larry, Bernard, thank you so much for joining us.
Thank you very much, Seth.
Thanks everybody for watching or listening. We will talk to you or see you next time.